Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Santa Barbara, California. Welcome to the show, Buck Joffrey.
Thanks for having me, Victor.
Well, great to have you here. It's been a while since you were last on the show and since we saw each other in person, but great to have you here. For the folks who haven't met you yet, perhaps give a little bit of your backstory and how you got to this point in your journey.
Yeah, I'm actually trained as a surgeon. I went through the traditional good student path. Ultimately, went to medical school, did a surgical residency, and I actually was kind of inspired by Robert Kiyosaki back in, right as I was finishing residency to go more towards entrepreneurship, not necessarily just real estate, but I ended up starting some businesses, made some money, started trying to invest that money, and was looking towards real estate because my family's a real estate family in general. I was trying to learn a lot more myself, so I got involved with, I started listening to a lot of podcasts. Now, that was back in when there was not that many podcasts. So that was probably 2012, 2013, and ultimately realized that I think I should start my own podcast because it'll help me learn, it'll help me meet people, and ultimately, hopefully fill a vacuum of the types of listeners like me who were high-paid professionals who were trying to figure out how to invest in real estate, how to invest in alternative assets in general, how to view the world independently, the financial world independently, rather than simply, just handing over your money to wealth advisors. So.
Yeah, absolutely. So you're involved in a number of different projects. You've syndicated a lot of real estate, mostly in the multifamily space. The last couple of years have not been kind to the industry as a whole. What's transpired? What have you had to pivot? Where are you focused today? What have been some of the lessons?
Well, I think like a lot of operators, we certainly took our lumps, and I don't know anybody who didn't, frankly, who had significant assets under management. But with every situation like this, you look and you say, well, there's blood in the streets. And if there's blood in the streets, I'm going to have to act, even if it's my own blood. Right. And that's kind of the positioning that our group has had to take. And, I think it's interesting. It's an interesting time because, as you know, compared to valuations of 3 years ago, property valuations are down, 30 to 40%. So when there is an opportunity to buy, I think we're considering this as a very good chance to get into the market again. Right now it seems to be the redheaded stepchild of the markets. You've got the equity market exploding, gold's exploding. Meanwhile, real estate is what's on sale. And I think people will start to figure that out if they haven't yet, because it's one of those things that to me is just kind of a blaring. When people go to the store, they look for things on sale, inherently, like that, just a natural inclination to do that. But when they invest, they're not necessarily looking for things on sale because they look for some reason unattractive. They look like rejected items rather than things that could potentially be of great value. I think that's where we're at in the market. There isn't a lot of liquidity to this market.
Correct.
If you have people who are holding on, operators that are holding on because they bought at much lower rates, they don't want to sell. They're not going to hold on as long as they can for recovery. So the real opportunity is just to be able to find those one-offs where it's a great asset, it's a great market still, and it's unfortunate, but the capital structure is just requiring a seller to exit, and that's kind of what our game plan has been.
There's a school of thought that says that many of these projects that were initiated in the early 2000s, 2020, 21, 22, were ill-conceived from the perspective that the cap rate compression between Class A and Class C made no sense. Like, it really made no sense that a C-class asset should be valued so close to a brand new building, something that was one step away from being functionally obsolete. There's no way it could be valued as much as a brand new asset. And yet that was the reality. And people went into the market thinking that if I just take this apartment complex and I add washers and dryers and maybe jack the rents a bit and maybe give them high-speed internet. I'm going to create enough value that certainly works in the latest version of Excel, but maybe not in the real world, right?
Yeah. Yeah. I mean, it worked until it didn't.
Exactly. Yeah.
And I think the challenge, of course, though, during that period was not only that we had a hot market and that, there was likely going to be some reversal of fortune there, but interest rates not only went up, and we certainly underwrote for interest rates going up, but we did not underwrite for interest rates going up at the pace that they did, which is really a historical slope at which they climbed. And I think that's the big part of it. It's the slope of interest, how quickly it all happened that created a lot of the issues. Yeah, absolutely. I mean, one of the telling things in hindsight of a bubble is it's hard to tell that you're in a bubble.
Absolutely. And I have this conversation frequently because I was in the tech industry in the 90s, and I remember 97, 98, 99. Man, it felt really good, and we couldn't see it. I couldn't see it. Almost nobody could. Only a handful cashed out in 99, and they look like geniuses today. Sometimes maybe they were lucky, maybe they knew something we didn't. Man, what a lesson in greed. And I see it today in the world, in the valuations in the stock market, where some of these companies are priced to perfection. I mean, when you have a company that is trading at, 600 or 1,000 times earnings, I mean, think about what that means.
Right.
Right? How much does that company need to grow in order to work its way into a reasonable kind of valuation? I mean, it just blows the mind.
Yeah, exactly. And so, again, I think people are excited about artificial intelligence. And I think you can create a narrative around artificial intelligence that says, like, listen, these companies, it's not the .com era, because if you look at some of these companies, they're making huge amounts of revenue.
Yeah.
They're real companies. It's not pets.com.
Yeah.
Right. And so I think that makes it even harder for somebody to exit at this point when you look at everything that's going on. So I think that's the thing. And then ultimately, like in a year or whatever, if there is a big correction, everybody can look back and say, oh, that was obvious.
No question. I mean, think about the companies that today are flying near the top of the market. And they were flying near the top of the market back in the year 2000 as well. NVIDIA lost 90% of its value. Amazon lost 90% of its value. I'm talking post-2000. Microsoft lost 58% of its value. You go on down the list, company after company. Some of them survived. Amazon certainly did, and others. But my goodness, how long did it take, if you acquired that stock at the top of the market, how long did it take before you got back to break even? It was a long time. It was a long, long time. And now, if you bought in 2001 or 2003 and you bought at that discount price and your dollar cost average down, great. You did awesome. But if you bought at the top and you didn't realize you were at the top and you had no portfolio insurance, you weren't hedging at all, you didn't have any kind of option strategy, whether it was covered puts or whatever, to give yourself some portfolio insurance, you were really exposed. So today, I think there's still money to be made in the market, but you've got to be hedged. There's no question.
Yeah, for sure.
So as you're looking at the market, when I think about the real estate investors that have done the best through market cycles, it's easy if you're entering the market at a time like this where you get to play offense and you don't have to play defense. But if you're having to play defense at all, the path is not just to play defense. You have to put your foot on the gas and acquire additional assets at a discount in order to rebalance the portfolio. Otherwise, you're only playing defense, and it's just like the company that tries to cost cut their way into greatness. You never do. You never do.
Yeah.
How's your thought process evolving?
Yeah, I mean, I think that's absolutely true. I mean, listen, I think we're finding things, if we're finding assets at 30 to 40% discounts in markets that we like, we're going to buy them. And I think from the perspective of, we talk about interest rates and inflation, which is something I'm thinking about a lot. My own belief is that we will see inflation numbers come down after this oil shock stabilizes. If you look at what was happening before the entire Iran conflict, every month, if you look at real-time inflation numbers, inflation was going down. So if your thesis is, and mine is, that this Iran conflict is transitory and that over the course of the next couple of years, things will become normalized. And then you have this in the background, this deflationary pressure of artificial intelligence, which I know you and I have talked about. It's hard not to see inflation coming down and rates following. So if you're buying in a discount right now in what are relatively, maybe not historically, but relatively high interest rates, and you anticipate a descending rate environment, that's a pretty good setup. And I think that's kind of certainly my thesis.
I know I don't have a crystal ball. That right. I know for sure. And sometimes when I have relied on that crystal ball, sometimes I've been right and sometimes not.
Yeah.
So the question is not really one of forecasting the future. It's making sure that you underwrite in order to survive a mistake, underwrite in order to survive something unexpected happening. I think that's where the art form in underwriting really comes into play. And the one thing I will not bet against is inflation. And for the simple reason that, at least for now, our politicians, our government is elected, and elected officials will use printing money as a means to stay elected, and that is inflationary. So in an inflationary environment, three things happen, right? You've got people on fixed income, their purchasing power is wiped out, savings gets wiped out, and debt gets wiped out. So the benefit of inflation goes to the asset holder onto the equity side of the equation. And if you can hold that asset, it's a transfer of wealth to you, as long as you don't fall in the ditch along the way. That's the key.
Yeah, right? Absolutely. I mean, even underwriting now with our properties, we're not underwriting with an expectation of lower rates. We're actually, anticipating rates to be stable. The thesis I have, I think, is more sort of a generalized thought on which way I think the market's head. I don't agree necessarily that I think we're headed towards continued significant inflation. I think that the deflationary headwinds of AI are extremely powerful. And I think we're going to see that. We were seeing that gradually already, and we're going to continue to see this again. One of the big things that I think you and I have talked about a little bit is the oil shock. And I think I believe that the Straits of Hormuz will continue to be an issue in the future, and that will potentially keep oil prices high. I think, there's some validity to that. I think that there is, you've talked about the drones, the one-offs that come in and create this sort of stress around the Straits of Hormuz. And I would say that I think that, first of all, I think the U.S. will be very aggressive in protecting the Straits. But even if you take the Straits out of it, there are other variables in the oil market right now. I mean, if you look at United Arab Emirates left OPEC, I mean, that is a big deal. That's a really big deal. That is going to create more competition. It's going to create an opportunity for prices not to be fixed by this cartel anymore. And then you look at the potential of Venezuela coming on in the next couple of years. I do think that there is I anticipate that the energy market is going to actually improve significantly. And right now, that's the biggest driver of the not only CPI, but of core inflation as well. So
when I think about the Strait of Hormuz, I don't care how many aircraft carriers stay there, how many guided missile destroyers remain there from the U.S. If the threat is perceived, then it'll translate into higher carriage rates for insurance, because the insurance companies are not going to take that risk. So there will be a premium for transiting the Strait of Hormuz no matter what. The cost of shipping through that channel is going to be higher. That's almost inescapable. And for that reason, it doesn't matter if the straits are closed or open, just the economics are going to be different. The economics of the Persian Gulf are different. Those are changed, I won't say forever, but for a long time. That's how I'm seeing it. Will there be other sources of supply? Will Venezuela potentially come back online? Sure. But the world order has changed. And so for that reason, what we thought were stable supply chains, those are being scrambled. It's an omelet right now, and we don't know what's coming out the other side. We know, for example, that even for new construction, material prices, at least in the short term, are up across the board. All GCs are getting that letter from their suppliers that start with "Dear valued customer." Effective such and such a date, our prices are up 3%, 8%, 10%, whatever the number is on a wide range of products. And is that underwritten into everyone's project? They're probably rising faster than rents.
Yeah.
So there's a lot of uncertainty, and investors hate uncertainty.
Sure.
It's an ever-present part of our reality. Is it permacrisis? I don't know, but that word is being used more often than ever before.
Yeah. Yeah. And then, the artificial intelligence, deflationary pressures, I think are absolutely huge.
Yes.
I think that's the other part of this thesis for me that helps to offset some of the concerns, not only about Straits of Hormuz, but other issues as well. I think that, it is increases in efficiency and competition between companies of being able to provide products at lower prices is extraordinarily strong. Now, of course, the other part of artificial intelligence that you and I have discussed a little bit, which I think will be very interesting, is to see the effects on the labor market. And the labor market, obviously, we need people with jobs to rent in apartment buildings, for example, right? Who does that affect the most? It probably affects the white collar guys the most. And that puts a lot of pressure on those top-notch A properties, right? And yeah,
if you think about communities like Phoenix that have a strong employment base historically, there's a lot of call centers in Phoenix, like a lot. Many of those jobs have been lost to outsourcing, whether it's to India and the Philippines, but increasingly they're going to be lost to technology that can replace a lot of those roles. They won't eliminate them, but there's a lot of folks that are in that space today. If they lose their job, where are they going to go next? It's not obvious.
Yeah. So the question is, how does that affect real estate?
Exactly.
Right? How does that affect the different, A class versus B class versus C class apartments? And that I think is very interesting. And to me, the one thing that I do believe in is that even though Elon is rolling out Optimus and robots, that is a much longer project. It's going to be, it's not a 5-year horizon where robots will be on the construction site instead of a bunch of guys. And that's the one thing I can take some solace in right now.
No question. And if I think about the rate of adoption of technology, it's often much slower than people think. If you look at even things that are modern conveniences, how long did it take for the cell phone to reach 50% population penetration? It's a long time. It's like 15 years. These things happen a lot slower than people think.
Although I think with AI in general, the software, or if you want to call it whatever component of that doesn't require you to buy something.
Yeah.
Right. That's already moving so quickly.
Correct.
Now, granted, if you look at, and I know you're a tech guy, but the software companies are dead on arrival at this point. They are, they're in real trouble.
Maybe because if they are playing a defensive role and simply trying to protect their existing business model, 100% agree completely. If they can augment their offering and leverage their install base to deliver even more value and bridge the world between what exists today and that future world, I think they have a pretty good shot. Because if they have the reach, they have the install base, abandoning what exists today to transition to something brand new, that barrier is high. And so if you can do it in an evolutionary way rather than a revolutionary way, those companies stand to do well. But if they're too slow, if they are too defensive, they'll get killed. There's no question.
Yeah. I think long term, I think it's a real problem for software companies, regardless. If you have an environment where you can, people or companies can easily create whatever software they want, there's no need for a third party at that point.
I'll share with you a perspective from the tech industry, having spent a little time there.
Yeah, sure.
And that is that if you look at the investment that goes into R&D and look what percentage of it is associated with managing platform churn versus delivering new value-added features, it's about 85% of the R&D investment goes to managing platform churn. So what is platform churn? This is what happens when there's a new release of software on the iPhone or Android or Mac OS. All of that, things that worked last week stop working because something changed. And not only do you need to fix that, you need to test all the different permutations and combinations of, does this software work with that version, all of these different things. And that it's the weight of that is, I'll say, crushing when it comes to delivering a product. If you're designing something that is just used by you and you only in a very narrow context, and it's going to be fragile outside your use case, no problem. I agree that you can spin up new products quickly. But if the integrity of your data matters and you want this stuff not just to almost work, but to really work, it's those companies that have the ability to deliver quality, and that's not hard. That's not easy to do. That's where all of the investment goes. And AI is going to make a big difference. There's no question. The startups are going to struggle to do that. They just don't have the scale and the heft.
Yeah. I mean, on the other side of that, there'll probably be entire industries devoted to helping people, create personalized software and upgrade it.
Yeah.
Right. On a regular basis. So I suspect that, I think there's just a massive upheaval in that space. Who knows what's going to happen, but I would want to be there.
Awesome. Well, Buck, if folks want to connect, if they want to learn more, what's the best way?
Well, I have my podcast. That's probably the best place. Wealth Formula Podcast. Mostly talk a lot about personal finance. We talk about macroeconomics, just trying to give people an idea, different perspectives on, what's happening with the world and which way it's going to head in the next few years so that they can hopefully make decisions based on some information rather than just guessing. So
right on. Well, Buck, great to connect. And for the listeners at home, definitely want to connect with Buck Joffrey at the Wealth Formula Podcast. Links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.